Strap yourself in for another banger. I sit down with Chris Davis of Davis Funds. The firm manages over $20 billion. He's been affiliated with the firm, which his father launched in 1969, and it has been more or less outperforming the S&P practically since inception. Not only was Charlie Munger his mentor, he sits on the board of directors of Coca-Cola and Berkshire Hathaway. The conversation was fascinating. There's nothing left to say, but my sit down with Davis Funds, Chris Davis. Chris Davis, welcome to Bloomberg.
It's always good to be with you. Thank you so much.
So before we get into your career, master's degree with honors from the University of St. Andrews in Scotland. Like, how did that come about?
Well, and one of the things that confuses people is I actually don't have an undergraduate degree. Mm-hmm. I only have the master's degree.
Wait,
I sort of skipped that middle step.
Did you go to an undergraduate college?
Well, what happened is I went to St. Andrews. I had originally only intended to go for a year. I wanted to be a veterinarian. That's a long side story. And I had worked at the Bronx Zoo. I had worked at the Humane Society.
So the original plan wasn't, Dad's a fund manager, grandpa's a fund manager. I guess I'm going to be go into the family business. That was not the plan.
Definitely not. But I give both of them credit. They felt that all of their kids should be financially literate, and
Fair.
So every kid worked for my father or for my grandfather at some point and learned, because they just felt like, look, you'll have money over time. It's not taught in schools, just the basic fundamentals of investing. And if you, God help you, turn on the TV, you're going to get a totally distorted view of what investing is.
A fire hose of nonsense.
Exactly. And so we all had this grounding. But, for example, my smartest sibling, without question, is my sister, my younger sister. But she's a small town doctor. Uh-huh. But boy, does she understands investing. She's very thoughtful in how she's managed her financial affairs. So we owed that route. But we all thought we were going different paths. She was interested in medicine. I was interested in veterinary medicine. And so I was going to go to Cornell. And I was very young for my high school class. Mm-hmm. And I was very late hitting puberty. I mean, I was 5 feet tall my senior year in high school.
Wow.
That's when I broke 5 feet. So, you can imagine what this looked like. But my scores and grades were okay. And so Cornell took me into their pre-vet program. Mm-hmm. But the woman that ran it said, look, this is a 7-year program. It's intense. Why don't you take a year off, like a gap year? So I proposed that to my father. He said, we don't do that in our family. Like you can go study, but there's no year off, to go ski or find yourself.
Did you skip a grade, or you, like me, the back of October, November, December, so you're young relative to the rest of the class?
No, I had skipped a grade sort of early because bizarrely, I didn't. Nobody in my family believes this now, but I didn't talk until quite late. Uh-huh. So they had sort of, and then when I started talking, they jumped to me
up for the
and exactly. It never stopped since then.
Right.
But anyway, so I had this year period, and it was the first year that the University of St. Andrews was interested in taking direct applications from students where they dropped the requirement to have A-levels or O-levels, the sort of British entry exams, mostly because they wanted the Yankee dollar. You've got to remember, Thatcher had just become prime minister. She was slashing the public support of the Scottish universities. So I applied. There were, I think, 8 of us Americans that came in that first year. And they had a program where after 2 years, you could apply into the honors program, which would allow you to concentrate on just one subject. And I ended up picking 2. But needless to say—
What were the 2?
It was philosophy and theology.
Huh, very interesting.
I'd picked them my freshman year thinking, well, when I go back to Cornell, I'm going to be filled up with organic chemistry and biology and anatomy and so on. So I may as well pick things that I'll never get to study again. So I picked things like medieval history, philosophy, theology.
I love that. That's something I always, in hindsight, wish I did. And I started out physics and math and switched to political science and philosophy. So I got to study some stuff that was fun, but like medieval history sounds like that would be a delightful semester.
You used the perfect word, fun. I mean, I became a good student in high school. I wasn't a good student. In fact, recently I found my elementary school, my 8th grade final report card. I went to a school here in New York, and it was a pretty strict, wear a uniform sort of boys' school. And the headmaster would review each report card before it went to the parents and then make a comment on the bottom. And the headmaster's comment on my final elementary school report card was, "Yet another semester of squandered potential."
Not living up to his potential.
Oh,
That's a classic.
My children found that. My mother gave it to my children, which was a big problem, you can imagine. But anyway, so I thought I'll just be in Scotland for a year. I picked subjects I would never study again. They were so fun. It was just...
Especially in Scotland, studying medieval history.
In a medieval university, and where Hume had been a professor. I mean, it was just amazing. And of course, it's also a Presbyterian seminary. So St. Mary's, which is one of the colleges there. So I thought, well, and I'm not. It wasn't that I was a deeply faithful sort of person. I more thought of theology from the point of view of, people organize their lives around religion. People die for it. People, I should study this. But there was a secondary reason that I was interested, which is if you look at communities that have a religious institution at their center, whether they're rural, whether they're urban, suburban, almost all outcomes are better. Intact families, crime rates, graduation rates, all of these sorts of statistics tend to go better. So to me, I was lucky that I was never, didn't have one of those childhoods where it was beaten into me or something. So it was more this curiosity about how it seemed to serve communities to have a shared value system. Anyway, I picked those subjects. I applied into this honors program, so I was able to get the master's at the end, but there was no undergraduate degree along the way. So
and there was no going back to Cornell to become a vet.
No.
The ardor for that faded.
Although because I deferred my admission freshman year, I still get mailings from their alumni department because I matriculated but then deferred. And I'd like to think the development department has nothing to do with them sending me these mailings. But I lived on a sheep farm in Scotland. And, of course, that was when I realized I was confusing loving animals with wanting to be a vet. And those are very different things.
Yeah, very much so. I'm always, as we used to foster dogs and get them adopted. And anytime I meet someone who's like, oh, I really don't care for dogs, it's like,
oh, that's a big X.
Done.
We weren't allowed to have dogs when I was a kid, but I grew up right in the city, on East 84th Street. And but my parents, from the time I was in maybe 3rd grade or so what would that be? Probably 9 years old or 8 years old, something like that. They said I could I could be a dog walker, provided I didn't cross any streets. So, I'd put up a notice in the elevator in our building if anybody needed their dog walk, and then I would just walk the dogs around the block before school and after school. I can still remember the name of every dog I walked, which is amazing. And I loved it. And, of course, it actually became seed capital, which is unexpected. But the reason was, I could probably charge 50 cents a walk back then, so it was nothing. But I got to be with dogs, and I enjoyed it. It was like a paper
And you're running a small business. I had a paper route, and it was just so formative.
So far. And this was like a paper route for city kids because you couldn't have a paper route in New York. But then an amazing thing happened. New York City it'd have to be around 1977 or 78, passed the pooper scooper law.
I remember.
And everything changed because people had these dogs nobody even knew what to do.
Right.
Nobody had ever imagined cleaning up after a dog. There were all sorts of inventions,
Just
tongs.
need a bag. It's not that complicated.
But people didn't. People were so gross. They had to carry shovels
You
with them.
change the diaper on the baby. It's just processed food There's no big deal.
Well, for me, it meant that my rates could go from 50 cents to $5, and people were glad to pay it. And instead of 1 or 2 dogs, I had 4 or 5. And it was real money, because what it meant was I was suddenly making, $50 a week.
In 1970, as a 10-year-old, that's good. That's good cash.
Yeah, and so you start, thinking about, holy cow, I'm making $250 a month. I'm making thousands of dollars a year, and it was just fantastic. So I've loved dogs ever since.
So let's talk a little bit about the early days of the career. You start as an accountant at State Street Bank, and ultimately end up as a unglamorous research analyst at Tanaka Capital Management. These are, very much bottom rung on the Wall Street ladders. What'd you learn in those?
Well, it wasn't really my first job. My first job was I became a pastoral assistant at the American Cathedral in Paris. Mm-hmm. So I moved from rural Scotland to Paris. Well, that was like landing in Oz. Right. You can, honest to God, my eyes lit up. But again, in the same way that living on the sheep farm convinced me I was confusing loving animals with wanting to be a vet, working for the American Cathedral convinced me I was confusing loving people with wanting to, be a priest or something. Mm-hmm. So I moved from there to Boston, and I thought about teaching. I actually even applied to the CIA because I was very interested in research and international affairs. I'd lived abroad then 5 years, and I thought it would be an amazing thing to be the greatest expert on, let's say, Czechoslovakia, to learn the language, the history, the people, the economics, the business, the military, the topography. And so I didn't want to be a spy, but I wanted to be an analyst. And the CIA wisely turned me down, having briefly had a stint in, sort of the Workers' Revolutionary Party, And,
so they looked at your history and said, this guy's a
they were like, wait, this needs to ripen a little more.
We don't know if you have the ethical malleability that we're looking for.
But I started thinking about the summers that I had spent working with my dad and my grandfather, both of whom loved their jobs. They loved investing. They loved their career. And, of course, that was infectious. Even as kids, I thought the idea of investing was so interesting because they didn't highlight the math to begin with. They highlighted the stories, the people, the ideas. But I realized that even though I've had this study of sort of the idea of businesses being made up of people and ideas and this sort of interest in that, I had no grounding in the rigor of it. And so what I like to say is my father and grandfather, let us live in a foreign country, like live in France for some time and hear French spoken and see this new culture. And we did that before we had to learn the grammar and read the textbooks and so on. So they got the order right for setting the hook of curiosity. But I knew enough to know that I couldn't go into investing without a real grounding. And of course, a bank is perfect. And I interviewed a lot of places. George Putnam himself turned me down for a job at Putnam. So I had a lot of rejects before. And State Street Bank had a program for entry-level accountants, and they had a wonderful training program. And so I had an operations center in Quincy, Massachusetts, and I would take the red line down there, and I could do my day job, but they would also pay for all of any schooling you wanted. They had something called the State Street Institute, and you could take courses in anything to do with economics, accounting, business, and so
you took advantage.
I took advantage of that. Although I will say I was fooled by one course. They had a course in their catalog that was called The Rules of Rhythmic Touch. Now, I thought
that sounds like massage.
That sounds pretty good, right? I figure I circled that one in the little course catalog. It was only a 2 nights course, and I showed up, and it was how to use a 10-punch tape calculator, without looking at your hands. So, when you're summing up
good
a column,
skill for an accountant, right?
It's the rules of rhythmic touch. And I would say if you put one on this table now, I would be confident. I would bet you a large sum of money I could run a column of numbers faster than you. I'm
gonna defer on that one.
But so I got the grounding there. Graham Tanaka was somebody I had met during my summer jobs. He was a very talented analyst at Fiduciary Trust. He'd been at J.P. Morgan before, and we'd sort of stayed in touch. And I learned that he was hanging out his own shingle and starting his own firm. And he's a Japanese American, really a very, driven, talented guy. And he said he wanted an apprentice. And it would be everything. I would be his first hire, and we would go from there. And that was a terrific experience.
How long did you stay at Tanaka?
I stayed there about 2 years, and we stayed because what happened after the first stretch is my grandfather, who I was close with, when I went to work for Tanaka, my grandfather opened up an account at Tanaka because he thought this was, he had big investments in Japanese firms. He had a lot of admiration for Japanese culture, values, and he admired.
This is late 70s, early 80s?
This was late 80s now. So
Late
we're
80s.
probably in 89, something like
great timing.
88, 80. Yeah. Well, but Graham was a growth investor primarily in the U.S. And so he just happened to have Japanese heritage. But so my grandfather opened an account. And as the time there progressed, my grandfather was worried about his health failing. He loved the business, and he wanted to die at his desk. And so he started asking if I would come in on the weekends and go through his accounts with him. And Graham, of course, was so respectful of that. And so it was sort of a very gradual transition out. There wasn't an end date of my time with Graham so much as there was a start date of my time working with my dad and grandfather.
So your father launched Davis Advisors in 1969.
Yeah.
And your grandfather was still running his Davis investing shop.
Yeah.
Parallel. Did they ever end up merging? What happened when he decided, all right, it's time?
Well, my father was my grandfather's only son, and as often happens, they had a very complicated relationship.
I'm sure.
And so they never worked together. My father, grew up with this famous name. Because your numbers were right in the beginning. It was $100,000 that he borrowed from his wife's family. It was $800 million when he died, and it was $2.2 billion when his wife died.
Wow.
And she was sort of the successor trustee, and then it all went to charity after that. He didn't believe in inheritance, but it was in trust for her, and she lived to be 106.
Wow.
Although I will tell you, I managed her account, and in 2008, of course, I had to go see her, and we had a lot of financial stocks, and we had a really bad mark at the bottom, probably down 40 or 50%. And I went to see her in Florida, and I said, Gran, I want you to know the businesses are sound. We took some body blows, but, in the long run, it's going to be fine. And she said, you idiot, I'm 98 years old.
What do I care about
She
the
said,
long
I don't
run?
buy green bananas, and you're telling me I'm down 50%, and you go get back to work. So she teased me because, of course, she lived long enough to see it all come back. And but she would always tease me about not buying green bananas and my telling her she just had to have a little bit of a longer term perspective. But anyway, so my grandfather built his firm, which was called Shelby Cullum Davis and Company. My father built his, which in the beginning was called Davis Palmer and Biggs, and then the New York Venture Fund was a client or a fund managed by Davis Palmer and Biggs, and when I was working at Tanaka, I went to a meeting. It was Chubb Insurance, analyst day sort of thing. And there weren't that many analysts then, so it was held around a big sort of boardroom table. And the CEO was Dean O'Hare, and he'd sit there and say, "We at Chubb, this." And I looked around the table, and both my father and grandfather were at the same meeting by chance. And I thought, this seems a little nuts. And so, I spoke to them both because I was very close with them both. And, one of the things my father was very clear on is he wanted out at age 60. He said, I'm not.
Really?
Yep.
Your age?
Yeah, hard stop. And here was my grandfather at the time, and he was probably in his
late 80s?
Early 80s probably then. And he said, I want to die at my desk. I mean, he was the one that called investing the best game in town. He would say, this is the best game in town. He loved his firm. He loved now his firm, most of it was his own capital. And so in a way, he was just managing his own, but he loved being in the flow. He loved, in a way, my grandfather loved being a great man. He had served as an ambassador. He was a co-founder of the Heritage Foundation, chairman for a long time. He had very conservative political views, although it was a slightly different organization
Very
25 years ago than
sure.
it is now. But he was a passionate Reagan Republican and sort of a Hoover Institute sort of Republican. And his namesake, Shelby Cullom, was a Republican senator and governor under Lincoln. Wow. So I mean, it was in him deep, and so he loved the game, and it wouldn't have occurred to him to stop working. My father loved investing, but he did not like the responsibility of the business. He didn't like boards and clients and employees. That was not his thing. He was much more a wonderful human being, but very different than my grandfather. So he wanted out before he turned 60. My grandfather wanted to die at his desk, and I thought, well, here I am. I don't know what I am at the time, 26 or something. And I was like, well, here's a great idea. Why don't we merge the companies, and then I'll come in and, I'll learn from both of you. And I was an S&L and a banking analyst then. And, of course, this was going right into the teeth of the S&L crisis. So it was an exciting time to invest. And then, we'll figure out a way for the three of us to do this.
And so how long did it take for that to all come together?
I think my father turned 60 in 1998, somewhere like that. And my grandfather died.
86?
Yeah,
88? 86.
Yeah, something like that.
Yeah.
Just don't quiz me. And then my grandfather died in, 1994. So I'd have to say he was 86 or 87 when he died. And so in a way, the timing all sort of overlapped beautifully. And so my grandfather worked almost to the end. My father helped coach me through that transition, and then he walked out the door in 1998, and that was that. And
wow.
He's been an incredible mentor. He's always available to talk, but as he said, I'm here to give you advice. I'm not giving any orders. And he didn't sit on our boards, he just walked out and just like my grandfather started giving his money away, and he created and oversees the largest international scholarship program on earth.
Really?
Yeah.
I know there's a foundation. I haven't read the book, but online there's John Rothschild, who was, I think, Peter Lynch's co-author.
He's a lovely man.
The Davis Dynasty, how odd is it to have, like, hey, the story, the game isn't over, and you're writing this book. How odd is it to be part of a book like that?
Well, first, it's probably a book read by dozens of people nationwide, because remember, it is the riveting biography of the dean of insurance stocks. So it's not, that's a pretty narrow pool.
Not a hot seller, you're saying?
And I do think I experienced the writing of that book as, sort of terrifying.
Oh, really?
Yeah, because it was
Lot to live up to with
it's a
your
lot
dad and your
to
grandfather.
live up to.
Sure.
And I will say it's something that I'm just profoundly grateful to my dad. Well, really to both of them, but my dad is a very humble person, and when you in that book it is 90% about my grandfather, and my dad was sort of what I would call a quiet doer. He loved investing, he loved research, but he was very low profile. And so his view was very much that despite the sort of graphic title, this is really a book about his father. And I think that that's true. And in fact, when we at our firm, we made slimmed down versions of that book and called it the Davis Discipline instead, which was much more consistent with our sort of view of life. Because dynasty implies sort of dynastic wealth. It implies inheritance,
and there's no inheritance.
And there's none of that.
Which I would imagine people would be surprised to learn.
Yeah, and it's funny. It's not something I'm quite as fanatic about.
Well, Warren Buffett is a big believer in, hey, if you give your kids, you should give your kids enough. I know I'm going to mangle this. Give them enough money so they could do anything, but not so much money that they can do nothing.
You didn't mangle it. You stuck the landing. That's and that is exactly the right philosophy. And I would say, my father, my grandfather sort of believed that. I mean, I have siblings that, where, they were helped out. And, I had an aunt, that my grandfather left some money to ensure that she and her kids would be all right and so on. So it wasn't ruthless. And I think it came from a place of sort of compassion. I mean, this sort of view that, there's something dignified about earning your way in the world. And I think there's, the idea of wanting, well, look, Barry, if you look at the greater world, there's a lot of fear. And fear can be a motivator, but God, is it a weight to, people live, one operation away from bankruptcy or, a layoff away from being foreclosed on. That is it. I mean, if you as a parent can put a safety net, if our society doesn't, if you as a parent can do that for your kids, and my grandfather did that, and my father did that, I don't think we ever grew up with the feeling that there wasn't a safety net. And so the freedom from that fear is a huge gift you can give your kids. It was a huge gift that was given to me. And that's what gives you the confidence to be able to try anything, right? Because you're not worried that, especially when you start having kids and you think, my God, if, I can't take this risk. I can't leave State Street. It's like it never occurred to me that I couldn't leave. But I think their view was, if you raise your kids with, the fortunate thing was both my dad and my grandfather were very frugal. And so we didn't live in hardship, but we certainly didn't go to Southampton and Palm Beach and Aspen. And, that was all, they had a very sort of puritanical sense of that sort of view that, we went out to Fire Island and we had a house on stilts that I still have a house out there, and it's in a swamp and it's one storm away from the end and there's no cars. You take a little ferry out there and I always think of it as the anti-Hamptons.
Very much is.
Yeah, and that's what I love, and my parents had a place in Maine, but it was just it was not a fancy
like a little
deal.
cabin, not Kennebunkport.
They had a nice house, but it wasn't a Newport mansion, and they had it because they used to call them in the 1920s. People like my grandparents were called rusticators. Isn't that a funny word? And it was people that were wealthy but would go and live very simply in the summer, and that it's very much just sort of a Scandinavian ethic. And I think it developed especially in the late 19th century, there was a movement called the Chautauqua movement that I'm still a supporter of, which basically said as the bourgeoisie and wealth was being created, there was this one branch of wealth creators that decided they wanted to be English aristocrats. And they built mansions in Newport, and they had yachts. And then there was another branch that sort of said that's not the American way. And they, and in many ways, I mean, Rockefeller in many ways embodied a certain amount of that sense of stewardship. Some were even more extreme in terms of restraint. But the Chautauqua movement sprung up and said they created these. There's still one left. It's in upstate New York, but where you would go with your family for self-improvement, and you would live simply, and there would be lectures. There would be, you would improve your mind, you'd improve your soul, and you'd improve your health. And you'd bring your kids, and there would be sort of day camp for the kids, and there'd be church on Sunday, but it was a non-denominational church that was about service. And then there was, there were lectures. It's where Salman Rushdie was stabbed. If you remember a couple of years ago, he was in Chautauqua. He was lecturing at this place that still exists. People go for a week or 2 weeks every year. So that's what the place I go on Fire Island was, part of that Chautauqua movement. But the ethos of it, I think, is something my parents and grandparents really subscribed to.
Huh. Really, really fascinating. We briefly mentioned Buffett earlier. When I later on I get to ask people who their mentors were, but I have to bring this to this part of the conversation. Warren Buffett and Charlie Munger were your mentors. Is this remotely true? It just seems insane.
Oh, I mean, it started in, I want to say it was might have been 1990, 90.
So he's already a well-known investing rock star at that point.
But the way it really started was with Charlie. I met Charlie long before Warren.
Oh, really?
But the reason was I was trying to sell a business. My grandfather, as I started going through his accounts and going in there on the weekends, he had a business called securities lending, and I don't know how well you know that business. Of course. And
anytime you're going to short a stock, you need to
borrow
it from somebody, and that's going to cost you a little.
It's going to cost you a little margin. So my grandfather's view was he had a portfolio of appreciated stocks that he was never going to sell, and he said if somebody wants to short the stock and pay me to borrow it, fine. And the number one borrowed stock in those days was Berkshire.
Hathaway.
Of course, because you couldn't borrow it anywhere because everybody had the certificates and they weren't
literally had the paper sales.
Yeah, there was very little Berkshire that was in street name. It was in individual people, and therefore you couldn't borrow it.
It was locked away in safes.
Yeah, so he had a big holding, and he had a broker dealer. Shelby Colm Davis was a registered broker dealer, and so he could lend out the shares and make a couple 100 basis points a year extra return on top of the Berkshire return. So that's how he started in the securities lending business. But gradually, the guy who was doing it for him and administering it said, well, we can also help. We've got all these people that want to short all sorts of different securities, and we can act as what was called a broker finder. We'll go out and find the securities for these people to short, and we'll make a little spread as they go through. Well, this business grew and grew and grew, and soon there were 17 employees in this securities lending business, and it was a big operation. And my grandfather by then was probably in his 80s and was nervous because as I went through the list of counterparties with him, there were firms we had never heard of. There was this one called LTCM. And I said, what is this LTCM? We've got $800 million lent out to them. What? Oh, that's long-term capital management. So we talked about it. He said, yeah, I think we got to get rid of this thing. It reminds me, by the way, of what Jerry Seinfeld.
So wait, did he hold on to that business, or did they?
So
it out?
I said to him, we got to get rid of this thing, and he said, fine. Well, see if you can find somebody to take it over because we do have 17 employees, and they've made their careers here. We're not going to fire everybody, and so we started calling around, and I thought, what characteristics do we need? We need a lot of excess capital, ideally an appreciated portfolio of securities, sort of a AAA type balance sheet, and somebody that can understand. So I thought, well, Berkshire. So a wonderful friend in those days named Bob Lenzner, who was a reporter at Forbes, but was very...
I recall I had lunch with him at, I want to say, the Harvard Club.
Yeah.
I think he was an alum.
It could have been. His kids, our kids
I could be wrong,
our kids were in the same elementary school, and I got to know him just, watching basketball game with third graders or something. And I heard his name around, and he said, he mentioned casually in the conversation that he had met this brilliant guy, Charlie Munger. And I said, well, I know who Charlie is, but I'm dying to meet him. And so Bob arranged for us to have breakfast. And Charlie was in New York, and I went down. It was at the Millennium Hotel down by the World Trade Center. And I went down, and I sat down and introduced Mr. Munger. Pleased to meet you. I'm Chris Davis. And I said, I'm working with my grandfather at Shelby Cullen Davis & Company, and have I got a business for you? And I pitched our securities lending business, and Charlie put up his hand after about 4 minutes, and he said, I have no intention of buying a business run by 7 guys named Vinny. And Barry, it was the perfect description. I mean, we had Vinny, Tony, Mikey, Nicky, And so we did end up finding a buyer eventually.
Just not Berkshire.
And it wasn't really a buyer. We just did sort of an earn out. We just wanted them to have jobs. And so they all got a job at a broker dealer. And
so beyond the pitch to Munger, how did your relationship
develop? So the pitch ended in 4.5 minutes. And so I said, well, I'm sorry I wasted your time. And I got up to leave. And he said, where are you going? And I said, well, he says, don't leave. I'm only just getting to know you. I'm not interested in your business, but tell me about you and tell me. And we got talking about, a few things. But what really happened was I started listening. And as you can tell, I like to talk. Around Charlie, I just listened as much as I could. And we sat at that table till lunchtime.
Wow.
And Charlie said, I have to go to a lunch. But if you find yourself in Los Angeles, give me a call and I'll make time for you. And so, of course, I started going to Los Angeles pretty regularly. And so that was a huge gift in my life. And it was a gift professionally, but my God, it was a gift personally. I mean, he helped me through some hard times in my personal life. I mean, he was just a wonderful mentor in every dimension.
So there is a lot of things that all of us have learned from Warren and Charlie through the letters, through the annual meetings, through just all sorts of stuff. I'm curious, what did you learn from Charlie that none of us can find in the public materials?
Well,
good question, right?
I think most deeply I learned about integrity in the traditional sense, meaning wholeness. Charlie was a whole person. The alignment, what he thought, what he said, what he did, they were all the same thing. And his sense of his own code of being was so disciplined, but was filled with this sort of, his reputation as a curmudgeon may have been cultivated. I never saw it. He was a truth speaker, but he was also, in a very profound way, a very loving person, very cheerful, very committed, profoundly loyal. And so it was, I used to sort of joke that if I did a Venn diagram of the things that I admire about my father and the things I admire about Charlie Munger, there's surprisingly little overlap. They were both frugal. But Charlie was an incredibly broad thinker. My father was just single-minded about investing. Charlie was curious in everything. Charlie was very sort of committed to to relationship continuity, to breadth. My father is very sort of specialized, very narrow. My father is incredibly physically fit and remains to this day. He's very vigorous. You know, Charlie was willfully sedentary. My father is very nomadic, and Charlie went to the same island in Minnesota and lived in the same house his whole life. Is very much a creature of habit, and so they were very different that way.
Just imagine if Charlie exercised, how much longer he could have lived.
I don't know. 99 3/4 is pretty good. That's one of the things he said. He said, "I'm not sure I see the alignment."
So let's talk a little bit about the returns and about the philosophy. Back of the envelope, I calculated Davis Advisors has been compounding shareholder wealth at greater than 10% annually since 1969. Does that sound remotely?
That sounds
accurate?
right. We're still ahead of the market from the beginning.
Starting out in 1969, so you're, early days of a horrific bear market. You have managed money through, well, you were in grad school, but your dad during the 87 crash. You're involved during the dot-com implosion, during the financial crisis, during the pandemic. I mean, you have seen lots and lots of cycles across all of these decades and all of these different environments. What key investment principles stand out as absolutely core, non-negotiable? This is the heart of what we do.
Well, the entire investment process boils down to these two questions. What sort of businesses do we want to own, and how much do we pay for them? And, the types of business characteristics that we focus, and the interplay, I should say before I go on, that the interplay between those two is part of the nuance of investing. You may own a slightly lower quality business because the price is so extreme. But the characteristics that we look for in every business have to do with the durability, because we buy businesses thinking our goal is to own it forever. Our goal is for the return to be driven by the earnings yield on the business over time, not by some change in the valuation and finding an exit strategy. And so those sorts of characteristics are exactly the characteristics you would look for if I said you've got to put a business away for your kids or your grandkids. So, the nature of the business, the returns on capital, the competitive moats, the nature of the balance sheet, the risk, and very importantly, the character of the people running it. We spend a lot of time on management evaluation. In this land of AI, I just came back from the Markel annual meeting. Character will not show up efficiently, I don't think, in the AI world. And boy, does it matter when you think about navigating an unpredictable future. Just that ability to be resilient, to adapt, but always to be investing the money as if it's your own. And there are CEOs that do that. So those are the nature of the business. And then the valuation discipline is sort of the securities analysis part of what we do. If the first part is business research, then it's the securities analysis. It's adjusting the income statement. That's where the accounting training comes in. And it is understanding the incremental returns on capital, and it's adjusting the balance sheet, every account on the balance sheet. Because, of course, GAAP earnings is a convention, but it may or may not reflect reality. And so, you put those two things together, and we build an IRR, an internal rate of return forecast. We work on this concept of owner earnings in each business, and then we focus on the quality and the durability of the business.
I can't help but point out that you talk about buying or owning businesses, not buying stocks.
No.
That seems to be like a very fundamental distinction compared to most fund managers.
It's so profoundly important. It is. We view ourselves as business owners. We view the management as our partners. In most cases, we view the signs of short-termism as dangerous. It's one of the reasons we feel that the activist movement has completely lost the thread and should be greatly resisted, whereas it was very useful when it started. And we could talk about that later. But absolutely, we're owning businesses, and we're trying to own businesses that are compounding machines. Right? I watched what it meant for my grandfather to own businesses for 20, 30, 40 years. I look at our own portfolio. I look at companies like, American Express or Wells Fargo or JP Morgan in the financial world. I look at, more recently at companies like Amazon, Texas Instruments. You look at what a business can do compound over 20, 30 years. I mentioned Markel. When I first met the now CEO of Markel, we met in Omaha at the Orpheum Theater at a Berkshire annual meeting in like 1990. The stock was at like 19 or 20, and it's at 2,000 now. And by the way, they have an activist idiotically saying they should split up the company. It's like a company's doing fine, and it's a company that is being built to last. And the idea of getting a quick sugar fix because you could sell some part to private equity at a premium, that doesn't serve capitalism, and it really won't serve the long-term shareholders of that business.
You mentioned a number of financials in that list. I'm kind of curious because financials have had some pretty good years. They've had some pretty rough years. Obviously, the financial crisis was, devastating. Although my pet theory about J.P. Morgan Chase is when they had their subprime problem, it predated everybody by 5 years, and there was still a bid when they had to get out. So they got a little lucky, and they happen to have a particularly talented CEO. But this concentration of financials, I'm curious what led to it, and I'm curious of the relationship between what some people describe as high conviction investing and concentration in a particular sector like financials.
Well, I think high conviction investing is exactly the right description. And if we end up with a focus on a particular sector, it's not necessarily because of a view of the sector. It's because of the individual companies. Financials is one of the most misleading sectors there is because, to me, what creates a correlation risk is when businesses are tied to the same macroeconomic variables. Financials is a massively broad category. Mm-hmm. There are financials that have risk if the wind blows in certain parts of the world. There are financials that have risk if interest rates change, financials that have risk that have to do with recession, some to capital markets. They are all different. And I'll give you a really powerful example. I started our financial fund, I don't know, in something like 1990. That fund from then to today has outperformed the S&P 500.
Really?
And it has outperformed the S&P 500 quite meaningfully when you compound it out. At the time we started it, I didn't even know there was a financials index. But it was founded with this belief that and my grandfather, of course, specialized in financials. I started as a financials analyst. And he had a phrase that he loved, which is, in financials, you can find growth stocks in disguise. And he said the reason is that you have you have businesses, industries that are huge, where companies can grow for a long period of time by simply growing. Just this year, Progressive finally passed State Farm. Progressive has probably compounded in the high teens for 30 years. And it still is just became maybe the largest insurance company in personal auto. So you have these massive industries where you can compound for a long time without outgrowing your sector. Second advantage, the business model doesn't really go obsolete, right? Making a spread on money is about the oldest business there is. Maybe the second oldest.
Right.
Thank you. What else? It's an industry where you have huge dispersion of outcomes, but relatively homogeneous valuations. So I mentioned Progressive. I mean, you have companies that have grown. Capital One. You look at Capital One's growth record from 1987 to today, and yet it's trading at 9 or 10 times earnings because it's a financial. I'm like, it looks like a growth stock to me, right? It's still run by the founder. It's a fintech company. It's a data science company. It's in the top 10 of all holders of AI and machine learning patents. But it trades at 9.8 times earnings and 1.2 times book value, liquidating value, with a mid-teens return on equity. It seems just nuts to me. But whatever. We love it. So that's the idea of growth stocks in disguise. And the last advantage of financials is that culture is a defining and sustainable difference.
This is a theme I have heard from so many really savvy executors, CEOs, as well as investors. How do you, as an investor, wrap your arms around culture? It feels like you almost have to be in it to see it. Like, is it something that, as an outside investor, you get access to? How do you identify quality culture?
Well, it's a perfect question, but I'll give you the punchline for the differentiation.
Mm-hmm.
Last year, our financial fund, which is 95% in large cap financials, outperformed the S&P Financials Index and the XLF, the largest financials ETF, by 1,200 basis points.
Not too shabby.
Right? It was a great year for us. But the point is that they're in large cap financials, we're in large cap financials. How can you get such dispersion? Right? But the same is true.
Because they own everything and you own the better companies.
But they're very concentrated.
Yeah.
They're concentrated in the mega cap banks by and large, and Visa and MasterCard, but we're fairly concentrated too. We only have 20, 25 names. And they, 20 or 25 names are probably 80% of the index.
Does the gap come from the stock selection or the screening out of what you don't like?
Well, it really goes back to the culture question. So to bring it full circle to your question about culture, what it is that within financials, we are looking for the companies that we feel can be compounding machines. And we're looking for the companies where their culture creates a durable advantage. The reason culture can create an advantage in financials is because in most cases, your cost of goods sold is an estimate. And if you have an aggressive management, they can use accounting to upfront earnings that you'll pay the piper 10 years from now. So they can look good for a long time. Whereas if you do the opposite, if you have a good culture, you're understating the near term, but you're building cushion for the long term. And so when the times go rough, when the tide goes out and you see who's swimming without a bathing suit, that's where the culture really matters. Now, you mentioned all of the crises that I've seen over my career. I've seen a lot of these management teams and these companies go through crises, and you see who's wearing a bathing suit. So we just went through an interest rate crisis, right?
2022, 500 basis points.
And we used to get questions from clients all the time. Why don't you own First Republic? In October, my colleague, Pierce Crosby, wrote a research report, just internal, just for his own, saying he's just startled by the amount of risk Silicon Valley and First Republic are taking. He said it's sort of amazing. Look at the duration on their assets. They're assuming that their liabilities, their deposits, are going to be with them for 8, 10, 12 years and that they're uncorrelated. So, we used to get questions, why don't you own them? They've had such great growth records. And our view was, well, it's been a mistake not to own them in terms of they've outperformed, but we are not going to own the companies that are optimized to the upcycle, right? And that's a different culture. They had a growth culture, but it blew them up. And so, we instead looked at companies like, well, J.P. Morgan was an outstanding example. Wells Fargo was, Capital One, where they didn't reach for the easy money of taking that extra risk on the interest rates. They could have, Jamie Dimon stood up at an analyst meeting and said, I could add $1 billion or $2 billion to my profits with a phone call. And I'm not going to do it.
Because of the risk.
Because of the risk. You guys want, I could put out my money for 5, 7 years, and he didn't do it. So when you could see that, so some of it is quantitative. You identify culture by accounting choices. Look at how accident year reserves develop at insurance companies. Look how credit loss develop. Look at the duration in the asset portfolio of a bank. Look at the mark-to-market risks that an investment bank is taking, so on. So you can identify culture quantitatively in financials. That's a big advantage. But then the next part is qualitative. And there, I think Warren put it best. He said in a complex financial, the CEO has to be the chief risk officer. And you can have somebody with that title, but if the CEO doesn't understand the nature and the complexity of the risks, they should not be the CEO of a financial company.
So not only am I hearing a lot of Warren's voice in things you say, I'm also hearing a lot of similar companies. Coca-Cola, Amex, Wells Fargo. Coincidence?
Well, I mean, it would be strange if we ended up different. Of course, I always like it when we owned it first. So, for example, we were, I think, the largest shareholder of General Re before Berkshire bought it, and so, yeah, and by the way, our research was not so good on that one.
Oh, really?
No, and as you see subsequently, Gen Re did not perform very well for many years. It was, and I think Warren would say, I mean, I think he has said publicly, I won't put words in it, but I think he said that was, well, I'll put it this way.
Not his favorite pick.
Yeah, well, I'll tell you what, Charlie came to visit us, and we have a wall of mistakes where we frame the stock certificates of our biggest mistakes.
Yes. Is that what that is?
Yeah, and Charlie was looking through it, and he said, "Where the hell's your Gen Re?" And I said, "Gen Re wasn't a mistake. We got Berkshire stock for Gen Re. That was fantastic."
Did you have anything to do with the transaction,
No.
or they just went out and bought it,
No.
and you happen to be a big holder?
And we were big Geico shareholders. So no, it was, and we overlapped in Amex, but no, I mean, we're much more diversified. We never owned Apple. There's huge differences. I mean, starting with the fact that, Warren has outperformed all investment advisors for 50 years. And so, but you'd be crazy not to study, if when Warren owns something, or to study Berkshire itself. And
that makes a lot of sense. There's another distinction between the two of you. You say that you are neither deep value nor go-go growth. So what does that leave you? Are you growth at a reasonable price, something adjacent?
Don't you love growth at a reasonable price? Because what are the other guys?
Who doesn't want growth at a reasonable
growth at unreasonable
right.
prices?
Or unreasonable
growth
non-growth.
at silly
Right.
prices? Yeah.
No growth at a reasonable price.
I think what we would say is it's obvious to us that growth is a component of value. Right.
Growth is a component of value. So
a company that grows profitably is more valuable than one that doesn't grow. Mm-hmm. Right. I mean, it's again, think of the business. Right. A business that grows profitably is more valuable. A business that can redeploy its capital at high incremental rates of return is way more valuable than one that it can't, or one that's capital intensive and shrinking and so on. So growth is a component of value. And the difference between us and a typical growth manager is we tend to believe more deeply, based on experience, that high rates of growth attract competition. Competition lowers returns. And so we believe in capitalism, and we believe that growth is hard and maintaining growth is hard. So we tend to be more skeptical than the average go-go growth investor. But we tend to be more open to paying a fair price for a company that can grow profitably than the typical value investor. So much of our research is about the durability of the growth, the competitive advantages that a business has. So our portfolio currently trades in aggregate, if you took all of our companies, at something like 14 times earnings, while the market as a whole is at 20 or 21. The value index is at 19 times. And yet we have a portfolio of companies that has grown their earnings over the last 5 years at something like 14% a year. So we feel we have what my dad used to call the value investor's dream, right? And that's what we
low cost, fast growth.
Low valuation and durable, sustainable growth.
Really, really fascinating. So before we jump too deep into the current state of affairs, I have to ask you about a quote of yours that I really like. As human beings, we don't welcome fear and panic, but as investors, we welcome the bargain prices that those emotions tend to produce. Discuss.
Well, obviously the market is, of course, a voting machine. in the short term. It reflects psychology, the long-term a weighing machine. And
Hold
that
on, that's a great quote. I'm going to write that down. Yeah.
And so psychology and helps shape prices. And what happens, we find, is that risk is, there's always risk. What varies is people's perception of it. And I think today we're in a time when people are underestimating risks, and therefore prices are generally high. It's one of the reasons I find it so amazing that our portfolio is trading at 14 times earnings. And I'm like, the market scares me at 21, 22 times earnings, but our portfolio feels like this is below long-time averages. So I feel this disconnect where I'm simultaneously pessimistic about the market because of the euphoria. There's no skepticism. There's no fear in prices. And at the same time, feel very comfortable with our portfolio.
So let me push back a little bit just to hear your reaction. We keep hearing artificial intelligence and NVIDIA and all the semis being compared to the dot-com era. And every time I hear that, aside from the fact that many of those companies, forget profits, didn't even have revenues, and this is a giant revenue, giant profit era, markets today are trading at 20, 22 times. We finished the 90s at 32 times. Theoretically, there's a ton of upside from here, and especially if earnings growth continues. Is it the contrarian take that, hey, this market could go another 5 or 10 years before things get really stupid?
Well, what I'd say is right now, as I look out there, I see two types of end investor. Right. One is this sort of belief that we're on a plateau of permanent prosperity. This time is different.
A permanently high plateau.
Yes. And they are all in on the momentum trade, which has worked so well. Now, I believe that momentum investing, even though it's worked so well, to me is crazy because it's not common sense.
It works until it stops.
It works until it stops. And when it stops, you really feel foolish that the fact that you are paying an ever higher price you thought was a good thing.
Why does price matter? If it's going up, buy it. If it stops going up, sell it.
Exactly. And so that's one group of investors. And they're taking a lot of risk because they tend to be in the highest multiple parts of the market and the parts of the market where there is the most presumption that high margins and high growth rates are sustainable. And the data is over. I think fewer than 3% of companies can maintain a growth rate in revenue of 20% for more than a decade, like fewer than 3%.
I mean, and that's a huge growth rate for a long period of time. Yeah.
And there are a lot of valuations today that have that baked in. You get these analyst reports. And there's even fewer, less than, I think it's 0.5%, but you could check me. It's either, might be 0.3, but it's a fraction of a percent that are able to maintain 50% margins for more than a decade. Those are very high margins, but again, they're in a lot of models right now.
Right.
So I think there's risk on that. Now, the other side of people taking risk are the ones that are huddled in cash, saying it's the end of the world, everything that's happening, AI is going to swallow our children, the world is falling apart, everything that's happening in Washington, and they're sitting in cash.
Which is risky as well.
Really risky. I mean, just since 2000, the purchasing power of a dollar is down something like 55%. Right? In my grandmother's lifetime, I think the purchasing power of a dollar fell like 94, 95%.
Right.
So
if you sat in dollars for 90 years. Right.
So I think these huge crowded sides of the market, the people sitting in cash and the people at the assuming the extreme growth, are both taking a lot of risk.
That's a terrible barbell you've just described.
Yes.
Like the extremes are either inflation's going to kill them or speculation's going to kill them.
And where I would say, we land in the middle is with this idea that there are durable overlooked businesses. right now. And they're business, as I say, we have a portfolio of 25 companies trading at an aggregate portfolio of 14 and a half times. By the way, that includes owning some Amazon. It includes owning some Google, but also owning some Capital One, owning some Tyson Foods, some MGM.
Which portfolio is this?
This is our flagship portfolio. So there's the Davis New York Venture Fund. But really, the way people are finding us increasingly, 10 years ago, Barry, we launched our ETFs. Mm-hmm. We were alone for 9 years. No, we were the only true active manager running a value ETF. I think our value ETF, which is called DUSA. DUSA is the number one active or passive value ETF for 3 years, but nobody really cares. It's just, but that's all right.
Although the past year or two, we have seen a lot of flows. Hey, most of the money going to the passive indexes, but the things that the third or quarter that's not going there, active.
Exactly. So they're finding our way. And I'm proud that we were so early. I don't mind being early, And so, but what I'd say is that the optimistic case you lay out, I think the three elements of change in the civilization that are increasing risk today is we certainly have a change in the monetary world order, right? Mm-hmm. You and I spent our entire careers in a world of falling interest rates, approaching zero, falling inflation, all of the things that fed into that, low wage pressure, deunionization, globalization, all of that stuff. All of that has stunningly and permanently, I believe, come to an end. We are in a state where we are printing so much money relative to what the interest rates are. I think there's a lot of risk, but certainly we're not going back to zero probably ever again. That was a once in history phenomena, free money. The second big change is geopolitics. There's no question that for our entire career, we were in a world of globalization. We're in a world of functional peace. We are in a world of stability. We're in a world where the wall fell and markets doubled. All of these things, that is also absolutely come to an end. And that increases risk. So those first two things increase risk. And what's the third? AI. There's this massive technological change that increases risk. It increases the risk of all different types of businesses. And it increases opportunity, but increases risk. So when you have three fundamental shifts going on, all of which have unpredictable outcomes, and yet you have valuations not at all-time highs, but elevated
sure.
highs, certainly relative to the direction of travel of interest rates over time, then I'd say, I like where we are with our 14 yield, solid growth rate in the businesses, durability, AI as a lens, globalization as a lens, inflation as a lens, put those things together. We sit with 25 companies with these great characteristics in our ETF or in our funds or SMA or however the advisor finds us.
Really interesting. So I'm glad you mentioned artificial intelligence as one of those three big shifts that are taking place. How do you, as an analyst and a fund manager, separate what is a transformative technology and potentially a transformative source of value creation from just the rampant speculative excess that rears its head on a regular basis?
Well, what we're seeing is Amaro's Law in full bloom. And Amaro's Law states that transformative technologies are overestimated in the short term. They're underestimated in the long term. We're in the overestimation hype phase. And what I would say we do is we recognize it as a transformative technology. Mm-hmm. That is absolutely a baseline assumption. Our other baseline assumption at this stage is that we don't see it as a winner-take-all. Mm-hmm. So we see it more a little bit like railroads or something where, or electricity, where the users maybe end up making more money than the builders. Huh. And so we'll talk about hedging that bet, but we do think it increases the risk environment in terms of terrorism. It increases the risk of obsolescence in certain businesses. So, but we start with this idea that it's real. Then what we do is, as we do our research, we found every company we look at falls into one of 5 categories. It's the emerging winners. That's where all the heat is, all the speculation. And there's real danger. You and I started very early talking about Cisco and remembering, well, the 3 obvious winners of the internet were AOL, Yahoo, and Cisco. You know, there 2 don't exist and one's a fraction of what it was. And so picking the emerging winners in the early hype phase is risky. And but we'd say if you want to look in that space, focus on the businesses that have a real shot at being emerging winners, but do not have to constantly raise capital, have proven business models, proven leaders, and businesses that are accreted by the investments that they're making, so that they earn more money by making these investments, even if it takes longer than we
not the hyperscalers.
Not the hyperscalers. I think that is, and so for us, that's where we've sat with a little bit of Google. We still have Meta and Amazon. We've trimmed the first 2 because they were huge holdings for us because we bought them when they were so out of favor. But if you're going to play in the emerging winners, that's the first. Second category is, okay, who are the enablers of this technology, right? That's the picks and shovels mindset. They're the ones that are going to benefit from the spending wave, but will not be penalized if the return on the spending is very low.
So semiconductors?
So, yeah, I would say there for us it's been analog chips, Texas Instruments. It's been semiconductor capital equipment. We're a big shareholder of Samsung, you know, which did nothing, and then went up fourfold in a year.
They're driving the entire Kospi in Korea returns.
It's amazing. Amazing. So, but, you know, again, that we viewed those as enablers. But in the enablers, I would also include things like natural gas and copper. Right? They are big beneficiaries. So we own, you know, Coterra, which is now Devon, ConocoPhillips, Tourmaline. You know, our focus is on natural gas and copper. Okay, so those are the enablers. The users, who are going to be the beneficiaries? Well, there you've got to think financials is a great example. Anything where you have a big amount of laptop class workers, right? It's what Elon called the laptop class. That, you know, it's likely that AI will do to the laptop class what globalization did to blue collar workers.
Meaning very much hollow it out?
Hollow it out. Hollow it out. The best will still have work. The best will be more valuable. They'll be more productive. But there's going to be a lot of unemployed second-year lawyers and things like that. And so so healthcare, you know, claims processing, compliance functions, things like that. So there we focus on the banks that have the scale, the tech stack, and the management to do it. So Capital One, number 1. I'd keep Wells Fargo on that list. I think U.S. Bank gets over that, crosses that chasm. So those, but also
Morgan Chase is part of that
JP
group?
Morgan Chase has done such a great job, but the valuation has gotten so high.
And how do you put the Amexes and MasterCard Visas of the world?
We don't own Visa or MasterCard, and we have a very small position in Amex. And essentially the reason is we just think that is an area where there's a big spread. They may be on the other side, but boy, there are a lot of people, especially merchants, that would like to figure out some way to bypass that.
That 3% big is a big number.
It's a big number.
This is the first time in my lifetime I have started noticing cash and credit card prices on restaurant menus.
Yeah, absolutely.
This was never a thing before.
And you really see it when you travel.
Yeah.
And so and again, they're so highly valued at 30 times earnings for Visa. You know, it just seems to us there's too much risk there. I'll own the Capital One at 9 times. So those are the users. Right. Then the next category are what Jeff Bezos, we call him the indifferent or the protected. Right. So what Jeff Bezos, when he said, people ask me what's going to change, they ought to ask me what's not going to change. That's a very important question. So what do we, you know, Tyson Foods. Right, chicken's not going to change.
Right.
And
wait, chicken's not going to lose their jobs?
Chicken's in good shape. And you know, but here you have to be careful because you don't have high growth rates, so you don't want to overpay. And they're cyclical businesses, so you don't want to pay at the top of a cycle. So Tyson, I think, has a low multiple on cyclically depressed earnings. What else does? MGM. I think owning, you know, 50% of the Las Vegas Strip and, you know, 20 or 30% of Macau and 100% of the only legal gambling in Japan and Osaka when it opens 2029. That's very valuable. I don't think that gets disintermediated by AI. So call those the protected, the what won't change. The last category is the Walking Dead. And there, you mentioned Visa and MasterCard. I don't know, title insurance. I don't know. There are all sorts of things where it is really amazing how much money is made for something that you should be able to get around. We've seen some of the pressure in the SaaS companies. And so that's the lens that we look at for all of our companies. We put them through this lens of this fast changing. We want to stay nimble. And Barry, one of the things I think is really important is I think this is a world where taking liquidity risk is really dangerous because there's so much flux. So I think that's some of the pressure we're seeing in private equity, private credit. I think people are saying, why did I lock up my money?
For 7 years.
For 7 years, if you're lucky.
Yeah.
It's going to be longer, I think. So I think that wheels are coming off that. I think that indexes, remember Kodak, you ready for a number? 10 million digital cameras had been sold when Kodak was still in the top third of the S&P 500.
That's amazing.
Isn't that amazing? And it's like 10 million people knew they would never buy a roll of film again. It was dead. And so the advantage, when Japan peaked in the 80s, every active manager in international investing outperformed for the next 10 years by just saying, oh, Japan's going down, I'm out. And so the index got killed because it had to sort of go down with the ship.
Right.
So I think nimbleness, liquidity, flexibility, and this sort of research lens are going to actually become more valuable. So I think we could see some of the time-tested things that worked in the last decade, dividend darlings, momentum, private equity, indexing. I think all of those things could be challenged given this fast-changing world.
So I'm glad you brought up a few things there, because when you look at some of the fallout from low-cost indexing, the Vanguard effect, BlackRock, whatever you want to call it, they have all put the fund industry under a lot of pressure. There's fee compression. There's been a move to not just indexing, but to ETFs generally. So when your own business, you're looking at businesses with moats and businesses with defendable processes and a good culture. You're running a business with a lot of employees and a lot of clients. How do you respond to this external pressure? How do you manage not the investments, but the business of investing when it's just becoming more competitive and more challenging than ever?
Well, we're lucky because we charge low fees, right? So if you charge 2 and 20, you're
if only I could.
I know, I'm jealous.
I mean, intellectually, I have a problem with that, but part of me is like, nice work if you can get it.
I know. I spoke to a guy that charged 2 and 20 years ago, and I said, "Why 2 and 20? What's the business model?" He said, "I can't get 3 and 30." So we've always just run with this idea. And Charlie once said to me, Charlie Munger, what's wrong with giving people a bargain, right?
Or at least a fair price,
right? And it makes it easier for you to outperform over time. So I feel two, we're a frugal place. I work with 7 colleagues. We've been together on average 20 years, 25 years average experience. And we would do this with no outside money, right? Because of the inside money. So we run it with what I would call a real family office mindset with our own money alongside in a very low-cost operation. But and the last thing, Barry, is we are in a lasting game. What I can tell you is if 90% of the market was passive, the remaining 10% of active would make a fortune.
I've said that exact thing. Hey, if indexing is taking over, doesn't that create all sorts of inefficiencies for a savvy active manager?
Absolutely. And I don't think it's a coincidence that we started outperforming the S. I mean, we've outperformed the value index for all periods, but we lagged the S&P in this momentum market, but that changed about 4 years ago, and nobody's talking about it.
Coming out of the pandemic.
But basically, we've been grinding an advantage over the S&P for the last 3.5 years. And this is with less than half the weight in technology that the index has. So we are underweighted the hottest sector, but yet we've been grinding out an advantage for 3 or 4 years. Why? And I think it's just because there's way more money indexed than is thought of. There's way more money in momentum. than is. And when I say there's more in indexing, it's because there's so much closet indexing. So I don't think it's impossible that we're already at 70% functionally indexed. So
Really?
that will really help us. So we're in a lasting game. We got the balance sheet to do it. We're going to be on the other side.
That's really fascinating. You mentioned you guys would just do this without outside money, but let's put some flesh on those bones. Davis Advisors, the company, the family foundation, you and your partners, the employees, you collectively have more than a few $1 billion in the fund. So you are not only aligned with your clients. I almost feel like skin in the game has become a cliche, but the question I want to ask is, being invested that way alongside the clients, how does that affect your decision-making process, and what does that do when you're going through one of those periodic crises that we've seen so much over the past 25 years? Dot-coms, GFC, pandemic. How does having skin in the game affect your decisions?
Well, I think it makes us much more rational and much more long-term. It means that, I once had a colleague that we had to part ways because he said that, I was so unimpressed by things like momentum, even if they worked. And he said, look, if I had a blind monkey in my office pointing to the newspaper every day at a stock, and every single day that stock went up that it pointed to, whatever stock it pointed to went up every day. He said, you could watch that monkey for 6 months, you could watch it for a year, you could watch it for 2 years, and you still wouldn't invest with the monkey. And I said, of course I wouldn't. It's a blind monkey, right? This is my money. This is my client's life savings. You think I'm going to say, oh, the blind monkey pointed at the paper? So when we're in an environment where the market is on a tear and people are saying, oh, you're dinosaurs, we're able to hold our discipline. In 2007, we had our financial fund had lagged all other financial funds, not all, but most other financial funds, because we were underweighted in real estate. And we didn't own any Fannie, we didn't own any Freddie, we didn't own any Countrywide, we didn't own Bear Stearns, we didn't own WAMU. And people would say, wow, you're like a dinosaur, and it's because it's our money. And so we don't mind if it takes a while for the reality, for that weighing machine to work. What we look at every year is, did the companies get stronger? Did they get heavier? Did they get more valuable? And if so, we view our research as working. And sometimes the stocks don't go up. Sometimes they do, but we're focused on the businesses.
On the process and not just what's going up that day. The blind monkey reminds me of a fascinating quote from Ken French of Dartmouth. Michael Mauboussin has written a lot about the separation between skill and luck, and French, of Fama French, had said, it's very challenging to tell the difference between skill and luck with fund managers, and to really have a data set where you can make an informed decision takes about 20 years. So if you're going to wait for that blind monkey, you got to wait 20 years.
Well,
and you're starting out with a blind monkey. I think we have to assume that it's luck and not skill.
Well, and look, Barry, your clients come to you. You could say that it's because of your performance, and performance matters. But
I don't think my clients come to me.
I was going to say what really matters is trust, right, and conviction. And so one of the things that we have clients that say, hey, you went through a period of underperformance. You were out of sync with the market. We weren't worried. You were building wealth for us every year. We don't care, oh, this index went here or the index went there. We're with you because we have conviction that you'll get us to our retirement, you'll get us to our kids' college funding, you'll help us achieve our goals. And maintaining, that's something you do with your own money. You don't chase the hot dot. But if you're an investment manager and all of your value comes from the assets under management, you have to chase the hot dot. So trust is an undervalued part of the promise and the value that an investment manager can give to their clients. If your clients trust you, they will get a better return, even if you underperform an index, if their trust is able to keep them invested through the ups and downs.
Really, really fascinating. All right, last question before I get to my favorites that I ask all my guests. What do you think investors are not generally talking about, thinking about, but perhaps should be? Could be a topic, a geography, an asset class. What important issue is kind of getting overlooked these days?
Well, I think, I think these three big transitions in the economy are going to turn a lot of what's become conventional wisdom about investing upside down for a while. So I think, what hasn't worked? Active management hasn't worked. What hasn't worked? Value, price discipline hasn't worked. I think you're seeing that. What has worked? Oh, alternatives. Illiquidity. That's been great. What has worked that I think is dangerous? Dividend aristocrats.
Oh, really?
Absolutely. I think that
You think dividend aristocrats are dangerous because
they're looking in the rearview mirror and they are not factoring in these big three changes that we talked about.
Well, isn't that the problem with all models?
Yeah, Kodak was a dividend aristocrat. Xerox was a dividend aristocrat. Polaroid was a dividend, and that's fine unless there is systemic change, right? And when you have a big change like you had coming out of the 70s, and the change into the 80s, 90s, you have these big changes, and then everything that worked, everything that helped you survive the crash and the depression in 1948, you could say, I'm not greedy. I just want to own bonds. Stocks are too dangerous. And you were wiped out in a generation. And bonds became certificates of confiscation. So I think people are underestimating how much these conventional strategies, alternatives, the backward-looking models, including even momentum, indexing, and versus active. And I would even maybe add international. International had underperformed for so long, and
just the past 2 years starting to look pretty good.
Just starting to look pretty good.
So you like international?
I like international. We run an international ETF, DINT, and it's just like us. It's all stock picking. It's run by my partner Danton. And our family probably has, always keeps probably 15, 20% our assets in international. And that looked really stupid until 2 years ago, and it's looking a little better. So I think those conventional things are being likely to turn upside down.
What's the old joke? Being diversified means there's always something to apologize for in your portfolio.
That's so true.
All right, so let me jump to my favorite questions. I ask all my guests, even though I would love to stay here and keep you chatting for another 3 hours. I know you have places to go and people to see. And the first question I always ask, I kind of know the answer, but I'm going to give you another opportunity, another swing at it. Who were your mentors? Who helped shape your career? And I kind of see 4 people already.
Well, you certainly got my dad, my grandfather, and Warren and Charlie. I think if I was going to add another one, I would add Tom Gaynor, the CEO of Markel. I just think, that sort of principled stewardship, leadership, that servant leadership, a company that is built with an enormous durability and culture of stewardship in mind. He's, we've served on boards together. He's helped me through difficult times. I've done my best to help him through difficult times. It's a great thing to go through life surrounded by people you admire. And of course, I get to work with people I admire, and that's a big plus.
Really, really interesting. Let's talk about, I know you're a fellow reader. What are some of your favorite books? What are you reading currently?
Well, I have too many favorite books to list, but
Give us 3. By the way, people always tell me, "Oh, that's my favorite question." I'm always looking for something new.
Well,
to read.
I'll give you the most recent one I read that I think is a good antidote to the AI phenomena or the AI hysteria, or the AI, the obsession. That's a better word. And it's a book called Alchemy. The author is Rory Sutherland.
Right.
Yeah, I think that's a very useful book to read right now.
On marketing and advertising.
It's really on ways in which we maybe fetishize, if I said that right, rationality, and that when you look at human behavior, it's very irrational, but it's often irrational in predictable ways. And the more we say, what's the rational solution to a problem, and expect people to obey that, the more we're going to keep getting crazy outcomes. People react in ways that, people react to placebos. but we don't study placebos, right? That's the example he gives that I love is if you wanted to create a really spectacular competitor to Coca-Cola and you hired McKinsey, they would say, well, you should make something that tastes good, sell it a little cheaper, and make it ubiquitous. What you wouldn't say is make it more expensive, make it taste bad, and put it in a smaller can. And that's Red Bull. And so there's a lot to study in a case like that. How has that worked so well? So I think alchemy is a useful one now. I think everybody should read themselves and then have their kids read Morgan Housel's two best books, which should be read as a single book. The Psychology of Money and The Art of Spending. They go together. I said one is like the sequel to The Godfather. It's The Godfather 2. It's not a different movie. It's
continuation.
It's the culmination in a way. And
you can skip 3.
Okay, that's
Godfather 3 just doesn't.
Oh, I agree.
Not as good as the first
I agree. And then for a third book, just the one that immediately comes to mind at the moment is Americana. It's a book there's 2 books by the same name. I know because Charlie had told
400 Years
of American Capitalism.
I love that book.
Isn't that
I had him on the podcast years ago.
Boo Srivanathan.
Yes,
yeah.
spectacular.
And it's
really just I think people are just so unaware of the history of American capitalism, and that book just does a fantastic job laying out the success story.
And it will help you as an investor if you think in chapters of that book. If you think about, okay, AI is unfolding. He talks about the interstate highways being built. Well, the interstate highways were built. Who made money, right? McDonald's, Wendy's, right? The railroads were built. Who made money? It wasn't the railroads, right? It was the factories, the ability to distribute. And who were the dead men walking, when the car was developed? But there were 3,000 car companies, right? There were 371 publicly traded internet companies. That's why picking the emerging winners in the early stages is tricky.
Always
but
hard.
Think of the chapter. Think of that whole arc. And that's a terrific book.
What are you streaming these days? What's keeping you entertained? Either Netflix, podcasts, whatever.
Well, anybody who knows me knows that I watch almost nothing, and I particularly don't watch sports. I don't know a lot about sports, with one exception. I love ice hockey. And I love ice hockey in part because we had a lot of family history. My mom's family helped start the NHL and founded the Boston Bruins.
Wait, what?
Yes.
And your mom's family helped start
the NHL. And
okay.
And founded the Bruins, and we owned the Bruins through my childhood. Can you imagine?
Come on.
What a deal that my father, who's probably been to 8 hockey games in his life, has his name carved on the Stanley Cup twice because Shelby Davis was the treasurer of the Boston Bruins. And so they won the cup twice. He got his name on it twice. But I think one of the things that I love about it is that my grandfather, in explaining his love for it to me, he said, every sport handicaps the athletes. You can't use your hands, you can't use your feet, you have to dribble, whatever it is. He said hockey accentuates every human ability. And
between the skates and the stick.
The skates, the stick, the pads, the oval rink, the ice. I mean, it's just an amazing accelerator of human ability. And I guess the reason I think of it right at this moment, of course, we're moving into the Stanley Cup playoffs. We're in the last 2 rounds. But it's also because I think there's a way to look at AI as accentuating human ability.
It's an accelerator, for sure.
It's an accelerator. And what that could mean for healthcare, what that could mean for healthcare inflation going negative. I mean, there are all sorts of...
We're already finding so many new molecules. If anything's going to find a cure to a lot of cancers, it's going to be this. And,
and again, we have to recognize that of course, like every technology, there are going to be negatives, there are going to be delays. And as people get disillusioned, we could get a big swing the other way. So equanimity. But again, going back to Americana and tying it to ice hockey, think of those long chapters.
All right, our final 2 questions. What sort of advice would you give to a recent college grad interested in a career in investing?
Well, I would say learn everything you can about business and ideally work in business. You know, I met a guy down at Markel had their reunion just yesterday. I just flew back from Richmond yesterday. Their reunion is a great event. I recommend everybody go. Just buy a share of Markel, go to the reunion. You'll see something a lot. It was compared to Berkshire, but I love the value system there. But I met a guy who was an engineer at Altria, which is headquartered in Richmond. He owned a lot of Altria. He owned a lot of PMI. But he started investing for himself about 20, 25 years ago. He showed me his portfolio, including his cost basis. He's built a wonderful record as an investor. And so, I think I don't love all these kids going to the Goldman Sachs and to private equity. I think private equity it was a wonderful business to begin with, and I think it is absolutely lost the thread.
Well, the size, it's just ramped up. And
they're all
gotten
selling
so
to
big.
themselves.
Right.
And they're trying to get the widows and orphans in there so that they can
Unload?
have some final sale, just like they did with MLPs and the oil and gas partnerships in the 80s. And I really hate it. There are people within the world of private equity that I admire that have built stunning records, but most of what's happening at this scale is just stealing money from pension plans,
401ks.
from endowments, 401ks, and it's going into penthouses and Ferraris. Where are the customers' yachts? Look at the returns over the last 10 years of the average state pension plan. Then look at the breakdown of assets, and you realize that all of the drag on their returns is alternatives.
Huh. Amazing. Final question. What do you know about the world of investing today? Might have been useful back in the late 80s, early 90s when you were first getting started.
Well, every investor, if they're honest, will say that their biggest mistakes were what they sold. And so, I would say that I've always put all my money in the funds, and I think that's the right alignment. But I realize now, which I didn't realize then, that there's some real differences, which is that, in the funds, we have to really think about diversification. If each time I bought a stock in the funds, I had bought it in my own name instead of putting my money in the funds and buying it, I probably would have just left it alone for the last 30 years, and it would have done very well. All of the, I first bought Amazon in 2002.
Good timing.
But I sold it in 2004.
Bad sale.
Thank you.
I could tell you the same story with
all,
Apple.
Yep.
It was $15 with 13 cash.
Yep.
Tripled my money.
Yep.
I was a genius.
That
was like 10,000% ago.
I know. We did the same thing in Apple, and we viewed it as a real estate play. We said if you mark the real estate to market and add it to the cash,
it was free.
It was an 80-cent dollar.
Yeah.
And then when it went to $2, we were like, whoa, too rich for our blood. So I do think that I'm trying to really learn and think about how can I improve results over the next 20 years by being more willing to hold. And what does that mean in terms of position size? What does it mean in terms of volatility? What does it mean in terms of client expectation? Would I feel the same if a client has $25,000 with us that I would if it was just my own money? Because I can absorb a bigger loss and I can absorb more volatility. So that's something I'm still trying to process. But God, I love the business. And, like my grandfather, if I could die at my desk at a very old age, I do have the best job on earth. I get to study success. I get to work with people I admire. I go and visit companies to focus on that elusive idea of culture. I get to meet the incredible people that have built our society, that have built businesses. And we have a country that loves to tear down the heroes. So we admire the guy on the way up, but once they succeed, we somehow decide they're a villain. I don't think that's constructive. I think it's a strange thing for us to admire athletes and not admire Jeff Bezos for what he created and how it has served all of us every day. We all use Amazon, and it serves us. Every day we delight in seeing our kids on Instagram or using Google Maps. And, the idea that we continue to vilify our heroes instead of judging people by their biggest accomplishment, not their weakest moment.
Chris, thank you so much for being so generous with your time. This has been absolutely delightful. We have been speaking with Chris Davis. He is the chairman and portfolio manager at Davis Advisors. If you enjoy this conversation, well, check out any of the 641 we've done over the past 12 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you get your favorite podcasts. I would be remiss if I didn't thank the crack team that helps put these conversations together each week. Alexis Noriega is my video producer. Sean Russo is my researcher. Anna Luke is my podcast producer. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.